Hi there, Alpha Team Planter here. Sorry about the husky voice. Must have overdone it a bit in the sunshine at the weekend. So I've been in catch-up mode. You all know I've been away a little bit, working and family stuff. So this is a bit of a bumper edition. Lots and lots of charts. People talk about markets being a random walk. Could go either way. Well, this is one of those situations where we need to have an eye on the ball because it literally is. Um, a sort of defense versus attack situation. This market now could really go either way, depending on particular read throughs from CPI this week, but just the way that everything is building up below that and the performance of a lot of the indices and some of the currencies, etc. So we'll work our way through that, and it'll give you lot of things to hang your hat on for how to trade this week. So as I said, quite literally on a knife edge, and there's a quote there from how I messed up my own cricket batting performance at the weekend just by taking things for granted rather than actually watching the ball and playing it on its merit. We need to watch this market completely. Remember, I said months ago, weeks ago, that if the data in the States starts deteriorating, it will go very quickly. And that may even bring in 50 basis points cuts when all we've been talking about is 25. I have to keep an eye on that, but some of the employment and activity data does appear to be dropping quite quickly. So keep an eye on that. So defense for the upside story for markets, obviously the dollar we've talked about, the seasonality missed. That looks like we may have one more little sell-off in the short term to put in a first wave of this larger scale wave 3 down. In essence, it's going to be quite choppy, fits with what the data is before it sells off. There is an outside chance, which we presented it before, that we've actually bottomed a lot earlier and we're actually working our way higher. The thing that we expected to happen in the second half of this year may have been brought forward. The whole rate scenario could make that go to new highs yet again. It's been a frustrating recalibrating of the second wave for quite a while now, but we'll stick with the first case scenario in that it's choppy and it's working its way down, the dollar weakness, and hence supportive for markets. I mentioned it last week, the growth in earnings per share and the ratings post the earnings seasons around the world, particularly in the US, has been typically strong. It's not been blowout overall, but it's certainly been blowout from the Mag 7. And Nvidia hasn't even reported yet. And I still feel like there's a big chance that drives an all-time high next week. We've got the rate cycle suddenly coming back into view. September has now become odds on again for some form of rate cut. And that really is interpreted as the Fed put. It used to be called the Greenspan put, then the Bernanke put, the Fed put now. They haven't attributed it to Powell and his team just yet, but it gives them the opportunity of being supportive to the market with a rate cut to keep the growth channel going if that continues to slow down. And remember, I did meet the plunge protection team in Italy last week, so they're on standby. Some of the indices had their overall best week of the year, and there's been quite a lot of sequential days and weeks in a number of the indices. There's only really Japan going sideways. A lot of indices have recaptured their 50-day moving averages, despite the fact that a lot of them are only just over the equal legs. So, as we're presenting along here, remember the equal legs is the kind of consolidation which then reverses. That is just a consolidation pattern, which would mean that the trend is down. So, we do want to see these rallies carry on and move towards that 1.236, 1618 range and beyond. So it gives us that impulsive breakout. And as we'll show, a number of those, if that happens, will actually take it to an all-time high. So particularly here, the Dow Jones, we've had 8 sessions up in a row, and the all-time high is in sight up here, just short of 40,000, and that would be a 1.618 for this current leg. At that point, you are thinking that's surely beyond the realms of just putting in a reversal consolidation, and I think a lot of bears would start recalibrating that and would talk about as being in the fifth wave that has been our central case all along. So keep an eye on that. The one cautionary tale along all of these charts at the moment is just look at this. The volume profile is picked up, but the average is still quite low relative. The Dow's not the worst of them, but they're in the positive advance declines. The advance oscillator's up, the momentum's up, and that does look like a middle wave. I'd expect to see that put in a new relative momentum high if we carry on going. So that's all in line. The Nasdaq 100, we've had that flip flop of data we talked about. We've recovered from the lows. So are we pausing? That again, it's recaptured its 50-day. Has it got enough momentum to take out that high? Again, this might be a lot of these indices until we get some real clarity this week from the data. It may well be worth playing some stop losses with the all-time highs, just in case it breaks down. It could even be a consolidating breakdown before we push ahead. But it is very much a 50-50 kind of setup at the moment. We do need everything to net push on. So we're probably going to pause, and it may retest that 50-day moving average this week before we go again. Should be lots of flip-flop to data. All of these things are back in positive momentum, but we need reasons to push on. I will show that you definitely should have the stop loss on, because the old adage of selling may go away is definitely seems to have died a death over the last few years. There's some good research out there which will show you a little bit like the dollar seasonality. Most of the time it plays out, but June to August is a very strong period for the markets in the last decade. So we don't really want to be taking that on. And that would fit very nicely with the fifth wave in this current three-wave structure and perhaps moving beyond. So keep an eye on that. Oil, been quite frustrating. Week after week, we keep getting these inventory builds, very little drawdown. The US is pumping more oil than it's ever done and is in the ascendancy globally. Obviously, we are getting demand uplifts, but at the moment, the US seems to be squirming all over it. Perhaps this is their plunge protection team. One of the tools, maybe, to try and keep inflation under control is to try and lean on oil, just pump and pump and pump until OPEC has to come in, and then the price potential creators. In the meantime, though, the technical picture does look like it's bottomed down here last week, and with this fourth low we were talking about, we're coming in for a small retest. That's probably in the conjunction, the connector part, but it could easily have done enough to carry on rallying. At the momentum divergence, the high with a lower momentum peak, we always like to think that is within this wave one structure. That's probably a subwave 3 and then a subwave 5. We're now putting in these sequential lows on momentum before it turns, and then let's hope we're back into that 80s situation. Because at the end of the day, we want the growth to continue. We don't want it to be breakout inflationary cost pull, but we do want the growth momentum to keep going. We don't need anything to put us off that mantra. Something I talked about a lot was buybacks. And we said, as the market sold off into the start of earnings season, a lot of companies have to go on hold officially under the rules and can't come back until they've reported. So they've all come back, and the aggregate, as shown by Goldman Sachs, is way over $1 trillion. It's a record. Well, it's nearly $1 trillion, $934 billion. Very supportive. And Apple, I think, they announced their a record one, didn't they? Which we talked about last week. Outside that, inflows are still positive into equities. Europe, Japan and China benefiting in the main. But I have seen chatter out there that I think it was BlackRock talking about the continued weakness in yen is starting to put people off. This, if you remember, I've talked about if you're investing overseas, you want the local currency you invest in to start performing. That gives you an extra return, or it chops a lot off. So of the double-digit gains in the Nikkei, about 6 to 7% of them have been stolen by the yen performance. Now, obviously, people go in and they hedge, but that again means that you are having to pay away some of your return. So we do want to start seeing the yen dig in a little bit more consistently, just to keep that momentum going. And I talk about another thing there, which one of the reasons probably why the Nikkei is going sideways at the minute is if people are still investing, the inflows still continue to be positive if slowing down. What happens is asset allocators tend to put that into the liquid stocks, and or the future, just to make sure that you're invested and will get any gains as you're trying to get into stocks you want to. Once they're invested, you start doing switches into the stocks you want. It's just a tactic that institutional investors and dealers use. So as you can see, looks like we're consolidating. I think we're in a two wave of a change. Change of label there. So I don't think it'll be long before the Nikkei resumes its upside. It's very clear 5 waves up there. We look like we've either done a 3 or we're putting in a double 3. So there's every chance that we rally. I would put in a stop loss low with the previous 4th wave really here, 37,600. I don't think you go too far wrong. As I said, Nvidia is coming next week. So net, are we going to travel and arrive, which means are we going to trade up into that and then have no further push on, or are we going to consolidate and then wait to see if it is blowout earnings? Again, I remember last year they jumped 30%, so a lot of people might just be waiting to reallocate once that's confirmed if they have another sequential year-on-year smasheroo to the upside. So there's a lot of support still there, buybacks, inflows, oil not causing any cost-push inflation. But, we do need the momentum to continue. We've done a lot of hard work. As we'll see, underneath the hood is a lot of quite worrying things, which are very easy to make a maximum bear case. So attack of the bears, clones, clowns, you name them. They've got a lot of things to look at. The VIX, we talk about fear and greed, and VIX is high. It's normally when people are really fearsome, when it's low, they're getting greedy. We probably haven't got to the greed stage yet, but we're certainly getting a little complacent about fear. If you look at this, 8 sessions, 8 days a week, I've called it. I love you, like the Beatles, 8 days a week song. And we haven't seen these levels really for the best part of a year. And in fact, if you look historically, we haven't really consistently been down here since just before the COVID situation. So, we are in quite ebullient stages according to the VIX. I haven't put the chart in here, but the high bond yields, high yielding bonds, they're equally just at periods and at levels and setups that have previously rolled over slightly and caused risk off moments. I know a number of people are looking at that. And I mentioned it earlier, there is an overall kind of lack of volume up here. We can see it here on the VP one. Even though, again, the S&P is set up, it's very close to the all-time high. If we're nervous, a stop loss with that in place might not necessarily be a bad trade to have on in the short term this week. The stocks trading above the 50-day moving average has obviously bounced, but it hasn't gone up to, the super strong bullish markets we've had before. So that does sit. I can see why people are concerned that this may roll over again. There isn't a super strength in momentum, and we have had divergence into this 3rd wave high here. The volume has been going the other way. So that is concerning a few people. Just classic divergences that sometimes just end a trend. So the data-wise, I was on catch-up. I was away for non-farm payrolls and ISM. I watched it from afar. Detail-wise, the trends don't look overly great. Eco surprises are obviously, as you can tell, and particularly we saw that in Michigan on Friday, inflation's missing to the upside, confidence and activities are missing to the downside. That is the classic setup for a kind of stagflation, but also for a very quick slowdown in the data and perhaps bringing on defensive rate cuts from the Fed. That will be interesting how the market handles it. If the data suddenly drops and the Fed are in defense mode, we talk about growth trumps everything. Will that be growth slowing down too much versus the rate kicker? Which one will end up winning out? So in the data itself, initial jobless claims last week, a big jump to 231,000. That's the first real sign we've had that's been in line with the weakness we've seen from other employment data. It's the highest initial claim since November, and previous to that, August. So there's a big series of lower data in control. Suddenly we might be in breakout. mode on the claim side. ISM, both services and manufacturing this week. I've just put in the overall data from around non-farm payrolls, and it's a horrible sweep, wasn't it? The average earnings was good for the inflation, but weekly hours down, manufacturing payrolls flat, non-farm was a miss, as we know. Participation rate is rubbish. Private was down despite ADP being up, I think. Unemployment rate going up. And then again, keep getting this divergence with the S&P global composites keep performing well, but the big daddy boy that we follow, ISM, horrible set there. Business activity well down. Employment deeply in contraction from being almost expected to be flat. New orders, they're slipping. The manufacturing PMI, services PMI overall went into contraction mode, and the prices paid, remember, came from 60s to this low print of 53, expected to bounce a smidgen, quite a big jump there. I actually need to go and look at the detail on that. I will bring that out over the week. Again, non-manufacturing employment, 3 consecutive months now on the services side below the expansionary. So, that's the biggest part of the economy, and it's not necessarily showing any positive signs there. This is why non-farm payrolls is suddenly looks like it's catching up with the ISM trend. Powell has said he will protect the economy versus a short blip up in inflation. So we need to keep that at the back of our minds when we're getting all panicky about CPI, which we could be doing again this week. But there you can see it in the numbers, and it hasn't been particularly special outside that one tiny contract expansionary print there. And again, just looking back to the manufacturing data, that wasn't special either. The national manufacturing came in bang in line on the expansionary line. The ISM was lower, the orders slipping back, PMI slipping into contraction. Again, it's the same thing. Prices paid, even on the manufacturing side, the goods side had a jump up. That was quite worrying for the rate argument, because this is the area that's been really muted. So you've got services, and goods both bouncing a little bit. And then our daddy boy jolts, we'll have a look at that in a minute, but that again is continuing the downtrend. The job openings are down, and we'll look at it. The quits rates are down as well, which people keep talking about, the people being able to jump into higher paid jobs. It's not a tight labour market in any at all, despite people still trying to look at the non-farm payroll headline. We know it's the part-time, full-time below that's the problem. And then here you can just see crude inventories on that particular week. What a massive jump up. As this was 2 weeks ago, last week, we did see this EIA data actually be in line with an expected drawdown, but the API missed. It's quite a pressure on the oil price at the moment, but it won't take a lot to make that suddenly break out. Well, either way, either the supply increases or the demand continues chugging up globally, and that'll soon use up the US extra supply. ISM manufacturing, again, look at this. Apart from that one blip there, we've had almost a year in contractionary mode. You can see it all in the individual prints. Some of those have been small beats to the upside, but the trend is still in net contractionary on the good side, still playing catch up. So he talks about jolts. Look at that massive downtrend since the peak in 2022. We've had a couple, and they did have a little effect at the time on, particularly that one in December, the end of January print. But since then, we've returned to the downtrend. Quits, again, this was a really super tight market into 22. Since then, we have been on a downtrend. So it's often looking at, what I'm doing this for is, you may see the data prints each week. Is it a beat or is it a miss versus expectation? Yep, that is important. And it's important to know where consensus is in the short-term situation, but we also need to have a look at what the medium-term trend is. And these have all been, a much looser market on the employment side in the States. And then our good old friend Michigan, bi-weekly, so it's always up with the mood of the market. But it looks like the sentiment side is caught up now. The inflation and the lack of rate follow through is beginning to hurt people's confidence. They're running out of savings. They're probably borrowing. There's a lot of shadow borrowing that doesn't come up in the official numbers, apparently. So people are getting quite stretched, having to do more than one job. There's no real tension in the job market, so they can't get decent raises. So it's all very much on a knife edge from the data side. And that was, as you can see, that's the consumer sentiment from Michigan. Bob's along here. And then all of a sudden the lie test, it's missed. Someone's just told a porky. And look, a record drop for the 2000s. It was an 8-point move. I think if you actually go back a lot longer, it's been a much more volatile series. But since the 2000s, that's a horrible print last week. No wonder the market was confused. You got, as you can see, the 1-year inflation expectation up again. That is short-term rates. We can see that. But last week there was just beginning to be a little bit of money market outflow. The CME tool starting to bring in the September rate cut again, potential. So, those inflation expectations, they look high in the short term, but they could certainly unwind. This week is massive. CPI, a fourth hot print in a row is obviously going to cause some issues, but we may well just be due that catch up on the rent side. Could all suddenly go gangbusters on the rally on rate cuts are coming. But this is consistently kind of bearish in the short term. Inflation expectations keeps missing every 2 weeks, and equally the same pattern on the 5-year expectations, but not as marked. Then it's all about other retail investors involved. I've seen some weekly flows that suggest retail is still short, and if you look at the CFTC data on Friday night on some of the indices, then it's the sort of other category, which is the retail, which are still net short or underweight. Now, some people have presented to me about leveraged ETFs in the States, 3 times their normal rate. So it's tough. Are people not necessarily invested in the normal way of investing? Are they just doing it by they're looking for big breakout wins, leverage products, etc. So the retail may be invested, but the normal data we look at very much looks like it's the institution side that is long and retail. The short and retail normally is the trend late to the trend, and you tend to take them on. So that again suggests that may not be as bearish as it would look if you can see short retail data. So either way, the markets have moved. They're at a technical situation where it could be deemed to be equal legs and therefore deserving to have another sell-off. The data is telling you that things aren't that great underneath, and that becomes a trade-off between the growth trumps everything versus emergency rate cuts, should we describe it as? So it may well be that this week, and with the backdrop of data that we'll discuss in a minute, it's going to be a tricky week. We'll have to play each data piece on its merits. It's probably due for a consolidation move, even if we're going higher. So it's one of those classic weeks where everybody's kind of, whichever way you're looking at it, it's possibly going to do the same thing. So net, it may be worth doing the stop loss sells, but my primary focus is that we're going to new all-time highs still and wave 5s. But you can see from what I've shown, it is a 2-way pull. Anything more than a shallow pullback, though, and it's time to get slightly worried, because that could easily accelerate into a proper double correction that we've talked about before. So whatever the bounce has been from the first low of this move down from all-time highs would likely replicate. A little bit more detail around the edges. Like I said, CME tool, 25% chance of a cut in July, which was much better than the 0 we've had for weeks. 61% was the net for September last time I looked. 75% in November and 87.5% by December. I think they're definitely fair. We've talked about it before. November and December are apolitical. They're both after the election. Sweden, first rate cut in 8 years. That was a nice fillip midweek and gave us an opportunity to dream about the Bank of England. They did give us some encouragement with a 7-2 outcome, with Ramsden moving into line, and certainly no dissenters asking for a rate hike. Still, despite Pill leaning on his, dull rhetoric, don't want to cut, blah blah blah, he did open up, and I've posted it on the preview, the thing that the boys put on the weekly institutional data chat, that the window is kind of open, the policy is tight, the odd rate cut, I think he described it as, wouldn't necessarily loosen or not make policy left too untight. Blah 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 blah. We could basically have one or two cuts and still have tight policy in place. Japanese yen, we're pretty confident they've had 2 yen interventions. Ueda had to go meet the Prime Minister. And the other thing that was of note about the yen last week was Janet Yellen, the anagram of L yen. She wants to yell about the yen. She actually said, don't do any more interventions without speaking to me. So that's quite encouraging. There may be some kind of coordination between the US and Japan to try and keep everything pretty tight. They don't want things getting too crazy either. There's a lot of carry trade. They don't need any irrational exuberance anywhere. Blah, blah, blah. We've chatted about the potential stagflation of Michigan. One piece of data that we do need to have a look at is the Atalanta Now GDP. What is that? That's bi-weekly again, every other Wednesday. And that is GDP measured up to date, more or less, as opposed to the criticism GDP normally is it's backward looking. This actually slipped through the net and actually was up on its last print unexpectedly. So remember, GDP was down previously because the imports were up, and we'll chat about what that is in a minute. But there's certainly something to keep an eye on there because it missed to the upside, or it beat to the upside. So growth trumps everything is there under the hood. Indices, we mentioned it, some have hit all-time highs, FTSE CAC and DAX in Europe. And the Nikkei is consolidating US. They're in the middle of 3-4 heaven, could go either way. And we've got Nvidia next week. Is it travel and arrive, or is it breakout on results? We mentioned that already. The Dow 8 days in a row had its best week of 24. So it's obvious that people may come into this week and take some profits, but it's a massive data week. Keep your eye on it. But what the most impressive chart I saw from anyone at CIS Group, Goldman Sachs, both reposted it. It was Bank of America work. And remember we did that dollar seasonality. They've looked at equities since 1928 on 3 monthly, quarterly basis, rolling, and 75% of the time since 1928, and with a 7.2% move on average, is June to August. You can see all these in the chart. So even May to July on a rolling basis is positive, and 62.5% of the time. So this sell in May and go away till September idea doesn't really pan out anymore. Don't really start getting a negative in the US until that sort of September period leading into, and this is particularly taking into account the seasonality for presidential years. You've got positives all the way there until you get into the summer. So this May to August period, I don't think you want to be fading the market too much. There's certain periods where you have to be invested, and it looks like a presidential year, and in that period is where you need to be invested. So that all sits really with the 3-4-5 heaven grinding to continued all-time highs. So is that data there suggesting that we're going to read through this, and any rate boost we get will keep the growth in the ascendancy? So lots and lots of positives for the market continuing to go high. Little discussion of some of the highlights from last week, nothing really important. Nvidia, again, another one that had regained its 50-day moving average. It's looking like it may well test that before next week. But as long as that holds and we get a decent update, I think it's a new all-time high here, which would be on the equal. It's not far off the equal legs, but new all-time high, 1.618. That probably means that continues rallying for quite a while. So keep an eye on that expansion chart. Commodities, we've talked about oil, gold and silver got a little bit crazy on Thursday. I talked about getting off the train. Luckily, closed out my short right at the bottom, but didn't go long. I didn't want to watch it. I wasn't going to be in a fit state to watch it, so I missed out on that. And then Friday, I've been playing a number of short bases. Talked about could it get back to the 23.50 level on an equal legs as well to set up a buying opportunity. There's every chance that may happen overnight or on the Monday session. And we'll have a look at that live on the live show, see where it's got to. Silver, expecting that to catch up. There's the setup, which will show below. Looks like that's going to hit $30 at some point, and there's a good chance that squeezes. I'll talk about another clever issue just to add to all the other things that we've talked about. There's a very good YouTube from Vince Lancy on what's going on in the silver market. And basically, he said the 12 most recent applications and granting of smelting refiner counterparty licenses at the silver exchange and equally gold at the LBMA have all gone to Eastern companies. There's none in the West. So this is really pertinent to the whole argument we've got about China and the BRICS wanting to control gold. It's all about where the physical is. So if the physical literally is being exported to the East and it's being processed and counterparted through companies in the East, then the natural home for the pricing is to be driven by whatever the East says the price is and dictated to the West. And everyone will look at that and go, what are you talking about? If you're in a physical market, whoever controls physical will control a price. We've shown how super biased the gold and silver markets are to leveraged paper trading. It won't take much for eventually somebody to fail in the West. Now, the consequence of that is that people will be paid out in cash, but it's the ramifications that will be the problem. At that point, as soon as there's any kind of technical pseudo default, if you own and control all the supply, you will dictate what people then pay for that. It'll be a massive run on the commodity, and hence that will just cement the pricing power of the East, which has been trading at a premium for some time to Western prices. There's always been chatter of merging those prices, but I think we'll see the Chinese price takeover for different reasons, I think. On the gold price there, you can see on the hourly basis, I talked about retesting the down channel just to make sure it was in. If we are in an up channel, we've put it in here in blue. We've now got a 1, 2, and 3 potentially. So there's every chance a 4 may come with a test of the down of the bottom line of that uptrend, or if it is a fourth wave, automatically you were looking at a 38 fib, which happens to be 23.49, which is what I was looking for. And that's an equal legs sell off on the way down. So that's why I suggested that was where I was looking to get involved. Kept trying to fade it. There was a lot of support into the close on Friday. Every time it tried to break, it only broke through 65 in the aftermarket, really, or the final throes of Friday's session. So that the sellers suddenly got a little bit of control. We'll see later whether they manage to push it down. But unless anything breaks this structure here, we should still be in that ascendancy to all-time high. The reason I put a yellow circle in there is to say it is a valid low last week, and you can make out a small 1 and 3, a rally, and then this final sell-off. It's a bit of an ugly finish. It wasn't as clean as I'd like it to have been. Certainly, if you were looking for this move down here to be all your 5 waves of what was quite a large, complicated structure, it's a pretty weak finish. Wasn't overly happy with it, so that's left me slightly concerned that this whole 3-wave move up, which has gone past the 1 for 1 and 1.236 kind of level, that's still in the realms of being a a consolidation wave, this could easily accelerate again to the downside, and this whole here be another connector of that original, what we've put in as a fourth wave could be the first WXY, another three-wave consolidation, then another one hit, another three-wave down here. So this could easily be a WXYXZ pattern. So keep an eye on that. If we break through that channel there is a decent chance we hit the bottom of this channel, which we originally thought we'd do before we went for the fifth wave, back down at 2220, 2200. We'll keep in for the moment the bias to the upside. We were looking for the pullback. Every chance we've got it. Let's see how it reacts from there. But keep those two scenarios, and they're massively divergent. They're a microcosm of all the markets at the moment. It's a two-way pull on the short-term gold setup. A bias to the upside, but could all blow apart. And silver again, that looks pretty much, that's a much cleaner three-wave for a wave four. But yet again, we've only really had a three-wave up. We're pulling back. That could be a connector for an equal legs there, which would take us 3.5 from there. So back down to 25.5 before we have the breakout. We will have the breakout, I'm pretty confident. But it's just about this getting through this very confusing setup week. CPI. Now, remember, PPI, as I've mentioned a number of times, is before CPI this month. Not quite sure on the technicals of why that is. It's generally the other way around. So you may have there's more chance of a positive read from PPI than CPI probably. A double whammy would be awesome. But so we might get some positives from Tuesday afternoon that then gets a bit panicky into Wednesday. So very much could be very choppy before we find out which direction we're really getting on Wednesday. I came across discussion that there's all this blockchain stuff going on, and everyone talking about central bank digital currencies and what is the real scenario with the existing cryptocurrencies, and what currency and setup of the BRICS going to come out with, and there could be an announcement imminent on that. But the SMB, the Swiss bank, have been practicing with local government and using tokenized payment systems. So apparently they've got a thing called Helvetia 3, that was the first one. So just keep an eye on all these headlines, because there's obviously a lot of chatter between the Western central banks, between them, of how to do this. Probably a lot of collusion, and probably letting the Swiss be the canary in the mine. So keep an eye on what the Swiss are up to for what to expect from a lot of the other central banks. It's a fairly quiet start to the week before Tuesday pops up. There's New York Fed inflation expectations. Doesn't normally have the same effect as Michigan, but we'll see whether it's followed the same trend. Tuesday night into Monday night into Tuesday morning, New Zealand electronic card retail sales, so the online stuff. PPI for Japan. Japan needs to start seeing some inflation somewhere. Will that come through with the weak currency into their input prices? That'll be an interesting read through, because there'll be questions asked. UK, it's earnings, wages, employment data. Eurozone, some final CPIs this week. We've had the preliminary prints 2 weeks ago for Germany and Spain. And then we've got German ZEW, the financial guys. They should be quite happy. OPEC will have a monthly report. As I said, PPI in the States, and oil API data. That's the one that has really been showing where the US supply is coming from. So we look for that. I think the crude will rally as soon as that API data catches up into drawdown mode. Wednesday, Aussie wages, the French final CPI, overall Eurozone activity, GDP, industrial production and employment. That should show continued bounce off the lows. Then the daddy boy, US CPI, we're looking for rents to really come through lower. Obviously, there's still, and this is where it's getting interesting. People will be describing, the longer this goes on, people are saying this is catch up supply chain stuff. It's all coming through in motor parts and in motor insurance and travel side of things. Can this continue to happen on the side where we've got rents slowing? If any of those components flatline, reverse, and rents actually accelerate their slowdown, then you're going to get a really low CPI print, and that will instantly ratchet through the bond market, the rates market, and be risk on. So everyone is actually prepared for the fourth hot print. So it's going to have to be super hot, pizza hot to get a real negative, I think, this week. New York manufacturing, Canadian manufacturing, then the second set of weekly oil data, the EIA on Wednesday. Thursday, Japanese GDP. We'll get a feel for, again, what's going on with the imports, exports. Aussie employment, the final larger economy, CPI, Italy, in Europe before on Friday they give us their total one. US, lots of data on Thursday, not necessarily going to move anything much. Building permits, got the trade data, housing starts. So some of those a little bit more real time, fully fed industrial production and manufacturing production data. Net, they should all be okay, I think. Manufacturing outside the ISM have all been reasonably around the 50 mark. New Zealand PPI on Friday. Japan industrial production and capacity utilization. Not a real lot to expect there. China, keep an eye on that. House prices, retail sales, employment, industrial production, fixed asset investment. We mentioned last week on the trade data that imports had a massive jump, and therefore that sound that we've been waiting for that to see signs of their domestic economy bouncing. So that could well be reflected in some of this data. As I said, Eurozone final CPIs for April, Canadian house price index, and the US leading index. So much quieter day at the end of the week. Talking heads, we've had a few last week. Bowman and Cook, I think it was. No, Bowman and Daly both saying they don't see a rate cut in 2024, and they're all. I mean, it's a bit silly. We've talked about before the talking heads, the dancing. They're all saying the same thing, all being pretty downbeat. The ones that are most vocal are the ones saying the opposite thing to Powell. It's getting a bit dull. It'd be nice to have a bit of data driving this one way or the other. So this week, Jefferson, the Mester, Thomas Jordan, the Swiss Bank, Cook and Powell on Tuesday, and that both of those, Cook's before Powell. They're both after the PPI, so they may have something to say there. Bowman, the only one on Wednesday at the moment. Thursday's a bit busier with Mordred and Nagel for the boo bet in Germany. They'll be downbeat as always. Mester, Barr and Bostic. Bostic will be pretty negative on Thursday. And then Waller, probably negative again on Friday. So not a lot of help unless we get the data, a good data read. That will be a fairly hawkish set of Fed speakers, I think, this week. Earnings-wise, we're very much coming towards the end, and the only one that really counts is NVIDIA next week, as we said. But some reasonable names: SoftBank, Petrobras, Ferrovial, so a bit of industrial in there. We've got Tencent, Home Depot, Alibaba, so a little bit of the Asians. The Flutter has now moved. That's the old Betfair, Paddy Power conundrum, but they have been very strong. They've got a strong US offering. It made sense for them to move. It'll be interesting whether they release something super upbeat just on their first reporting on that side. Vodafone, our old Greg's our favourite. We normally have a meme around Greg's. Nothing really major left. Siemens is a global industrial. Allianz, big insurer. Obviously Walmart for consumer trends. Sage, almost the biggest tech stock left in the UK. So pretty dull. We're getting very much, I think, over 80% have reported now in the S&P. Chart-wise, what's left? We've got the DAX. Another one that regained the 50-day. Momentum-wise, that did look like a third wave and a fifth wave within a third. This should still keep bobbing along. We're in a third wave. We should have another momentum high. Then a pullback. So it looks very choppy for this week, consolidating. I've only got that fourth wave in there because it's just in line with a decent supportive order, and it's a 38 fib, but not in love with it having to pull back that far. If market conditions are good, Germany has tended to put in shallow wave fours this year, so that may well continue. FTSE, everyone's suddenly at the highs now getting all bullish. I think that's probably right, and the rate cycle is okay. Corporate showing signs of a little bit of life. Certainly M&A activity. The earnings were good. We're in a third wave. I think, again, you can see, just draw a circle in there. We're probably consolidating and choppy, grinding out new highs until we, again, finally put in a fifth intermediate wave here, which itself will then consolidate at these higher levels, I think. FTSE does look like, after being in the doldrums, we change it to impulsive. It looks like that will continue grinding higher. The only problem being, again, the volume hasn't really followed through yet. But because of the nature of where we are in all of these setups, we need confirmation that the equity rally is going to take place. That I think the volume will catch up. Either way, after what happens to Nvidia next week, that is, I think, it's just a line in the sand that the equity managers just have to wait and see for. It's just as simple as that. We're going to have choppy range. This should be a good week for traders. We're going to be up and down all over the place, like magnificent men in their flying machines. UJ, we talked about it on the live show last week, feels very much like it's got one more high, and that would be overall as a wave, a 1.618 to finish, which would suggest you get a pullback and then probably even more highs going forward. But for now, we're in these sort of yen interventions. There's a little bit of chatter, as I said, with Yellen looking to help. But unless things improve for Japan, rates aren't going up. The data and people at large are worried about whether their wage hikes are going to come through and whether they're going to stay elevated and keep up with the inflation that potentially could come through in oil from the oil energy that they're a net importer of, with a weak currency, not a good mix. So people aren't spending. It all starts to make, this has happened so many times in Japan, they kind of lose momentum, in which case there won't be any more rate hikes. So this will, in that scenario, see UJ going a lot higher. Euro dollar, still think that is working its way to a intermediate wave one top of the high degree. We've had, pretty good, solid grinding higher. And it looks like we're consolidating here. I would expect as a bit of choppiness. It's all about being in line with the dollar still at the moment. We think we might be getting one more low short term in the dollar, which is probably how this 5-wave pattern finishes. And then we have a consolidation before we go again. It's very much a mirror image of the dollar situation. Let's hope that all sits with just, the whole rate cycle just coming a little bit more dovish, just as the double whammy, and then we should get that breakout, certainly to 110. And then, as usual, you can work your way through it. You've seen most of the tweets and memes during the week that we've put in. Was there anything we didn't talk about in there? No, there's the little piece that the boys put up. Some good quotes from Pill and Bailey, where we are there. So I think haven't quite reached the point to cut right now, but we're going to do it as soon as we can. And there's the important point from all that is there's two meetings before, two sets of inflation data before they make their June decision. And one of those will be a big drop in the energy price. What do you call it? The energy price level, whatever, the thing that comes through from the regulator. And that'll be continue the downward trend. So they're expecting a big pull down, which will allow them to justifiably put a rate cut in. Well, not a lot there. So yeah, any of the talking heads that were interesting. Williams, he's just resigned to, why are we all worried about the short term? It's going to come. We're still in a downward trend for inflation. Most of the hawks are just, dyed in the wool, not going to change, no reason to move, blah, blah, blah. Jefferson, Collins. Cook was saying that there isn't any signs of financial instability yet across households or firms, but as the data deteriorates, that could very quickly turn. Again, so they're suggesting inflation may take longer to cool. Yeah, this is all backward looking. We need to focus on the near term, and some of the data is beginning to accelerate in a dovish way. Bank of Canada, Macklem said their financial system is starting to get stretched because of the high rates. Recession chances fading, so it's making it difficult to cut. But that could easily reverse. Yeah, Pill came back on Friday and said any heavy focus on a June rate cut would be ill-advised, but not quite sure why he's being so resolute, because I think they'll lose anyway. I think the bias is 5-4 for that cut in June. So whatever he says is, I don't think there's anyone else joining their party of not moving. And I think if it's a draw, if Bailey has voted for a cut, it will be a cut. So they need someone to join the ranks of no cut. So yeah, that sort of wraps that up. We've gone through all data. So hopefully that's, and it's a bit of a long-winded catch-up from me, but hopefully there's some useful bits in there. Keep referring to lots of those data charts as you go through the next week or so, and we'll add to that this week. It's going to make for choppy trading. I wouldn't put you off stop loss as at all-time highs, just to cover that potential for more than a consolidating weakness. It could be a win-win there, but equally, it's going to have to be something super hot to return to downtrend for me. And I think we're just consolidating into Nvidia next week. Anyway, good luck with how you interpret it. Good luck finding your entries. Don't overtrade. Don't over leverage. Good luck. Keep grinding away. Over and out.